What if I told you that the difference between moving to Italy on June 29th versus July 1st could cost you tens of thousands of euros in taxes? Let me show you how the 103 days rule can make or break your financial plans in Italy. In the world of international tax planning, knowledge is power. I truly believe that. And with it comes with the responsibility to act accordingly in a strategic way. For expats willing to move to Italy, planning to move to Italy, one of the most misunderstood and yet critical rules to grasp is this famous 103 days rule of tax residency. It's a rule that seems straightforward on the surface, but can impact your finances if overlooked or used in the wrong way. So let's unpack it as much as possible. The 103 days rule is one of the primary tests Italy uses to determine whether or not you're a tax resident of Italy. They see if you spend more than 103 days in Italy on the calendar year, if your main center of interest, economic, personal, or social in general, is in Italy, or basically, more simple, you're registered to the anagrafe for the majority of the year. If you meet any of these criteria, even just one, you're treated by assumption as an Italian tax resident and taxed on your worldwide income. Fail to meet them, and you're only taxed on income earned or sourced in Italy. Let's pick Daniel and Emma, okay? Those are two expats who decide to move to Italy for a lifestyle and why not for a wine. They both work remotely for foreign companies and they earn 120,000 per year. But their timing made all the difference in how much they have to pay. Daniel is the early bird, okay? Daniel moved to Italy on June 1st of 2024. By the end of the year, he has spent 214 days in Italy, well over the 103-day threshold, by the way. And this made him a tax resident for the entire 2024 tax year, as Italy applies residency rules retroactively to January 1st of the threshold is met. So, how does it look like now? Worldwide taxation. Italy taxed Daniel entirely on the 120,000. The progressive rates are 23 to 43%, so roughly speaking, 42,000. Then Social Security contributions, another 25%. Total tax burden, roughly speaking, 70,000. June 1st. Let's move to Emma, the strategic planner. Emma, on the other hand, delayed the move to Italy to June, or let's say July 15th, 2024. By December 31st, she had spent only 170 days, way below the 103 days. So here's the breakdown. She's not a tax resident, so since Emma is working remotely, her income is not Italian sourced, so it's not taxable. Social Security contributions are not due. Foreign payroll, foreign company, foreign tax rules. By delaying her move, just for a couple of weeks if you want, Emma avoided 70,000 in taxes and contributions that Daniel had to pay. Timing really, truly is everything. While the 103 days rule is critical for determining your tax liability in the year you move, it's also essential to consider your long-term residency strategy. As you know, today Italy offers several tax incentives for new residents, such as the flat tax for high net worth individuals, the 200,000 flat on foreign income, the impatriati regime, the 50% tax discount, and so on. So, what's the lesson here? Know the calendar. Plan your move strategically and accordingly to your big picture. Even a few days can flip the scales on your tax residency. And leverage tax treaties. Understand really in details how Italy tax agreements with other countries can mitigate and impact the double taxation. And if you can, please consider seeking professional guidance. The Italian taxes is complex and a cookie-cutter advice rarely works. As Uncle Ben said in Spider-Man, with great power comes great responsibility. Moving to Italy offers incredible benefits for your lifestyle, for your speed of life, but it also demands careful tax planning. The 103 days rule is not just a bureaucratic math operation if you want, it's the key factor that could redefine your financial future. If you're planning to grab a tax discount, moving by the first half of the year will secure your seat. Even changes will change. Flip side, if you want to avoid taxes as much as possible, let's move in the second half and see how it goes. Whether you're dreaming of sipping espresso in Rome or exploring the Tuscan countryside, timing your move wisely ensures you enjoy the Italian life without unnecessary tax headaches. Remember, it's not just the destination, but also about how you navigate the journey and take care of every single step.